Hi, guys. Welcome to the 26th episode of WTW, the weekly trading wrap up, where we talk about the weekend markets from a trader's perspective, what to focus on, and what to ignore. So let's begin. Here we are again, as usual. We begin with a chart of the S&P 500 for the week of May 12th. Okay. This is the whole week. Gap up from Friday, a huge move from 565, let's say, 580, huge move in SPY, plus 3.3% the first day, and then Monday, Tuesday, Wednesday, Thursday, Friday, just continuous ride up. Okay, this is risk on behavior. Okay, so before we begin, we always start off with the technical picture. Okay, so what was the technical picture last week? Well, we said that, let's just get rid of this. You know that this is the whole week, so let's just get rid of this arrow so it'll be more clear. Okay, so the technical picture last week, we said that, okay, I'm just showing some moving averages again. We said that last week ended here. We said that we were ticking all the bullish boxes. We had big exhaustion low, a higher low, and then a breakout from this first high, from the first high pump, let's say, from the lows. And after that break, that's bullish. I drew a trend line from here connecting these two large points, and we broke it. So we had multiple bullish moves, except for one item that was bearish. We were still, as of last week, trading below the 200-day moving average. And because of that one fact, I said that we were neutral. Okay. Well, today, that last element has been flipped. The prophecy has been fulfilled. The golden child is loose. We are trading above the 200-day moving average. So now all boxes are checked. And we know that 200 is important because the moment it closes above that for the week, because this is the end of the week, if it dipped in the morning and then fell down, that wouldn't have been very good. But the fact that it closed for the week, a lot of funds are coming in and buying. Okay, just because it's above the 200. So this is risk on behavior. Okay. So we are in full bullish mode. Okay, what does the sentiment indicators tell us here? We'll look at the fear and greed index, CNN. We are in greed. Okay. Everything seems, well, this is a glitch. It shouldn't be extreme fear. It should read greed or extreme greed because the market momentum is greedy. Because we're past above these levels here. So there's like a glitch here. It should be greed or extreme greed, and every other metric that they're looking at is basically at extreme greed or greed. Okay. So what a difference a month makes. We are getting to the point where it is extreme greed. Now, what about the AAII investor sentiment? Better. Bulls are back up to like almost a historical average. We're at 35.9 on the bulls, 37.5 is the historical average, but we're still bearish. The average is 31. We're not even close to being super bullish yet. So we just started getting bullish, which is very positive for us, okay? So technically speaking, even the sentiment, while it is getting close to greed, the longer term sentiment is still quite bearish. And of note is that there's been a lot of call buying here. Okay, so we have not record lows, but pretty much lows in the put call ratio, if you will. You have it here on the fear and greed index. One of the elements is the put call ratio right here. Here it's at greed. But more than that, we see it. We see it everywhere. That's a 5-day average, but we see it in like any metric of the put call ratio that you want to see. We're at pretty much lows. So even though the technical picture is almost all bullish, there's one or two elements that are not, but that's not enough to like probably deter this train. What should be of note is that because this technical picture is bullish, we are approaching highs. Okay, I didn't initiate any real longs. I'm still sticking with the longs that I had. I sold a lot during this week, but I'm still net long. However, I mitigated that by buying some short exposure, either outright short puts, long puts, or I sold some call spreads, just to protect against a correction if it should happen, because we are getting into like halcyon territory, and the risk of going long here after everybody's buying a lot of calls is not very good. I mean, what, you're going to reach the all-time highs, and what's the low? We can hit the 200-day again, or even fill this gap. Like if all gaps get filled, we can go back to the 565 level. So the risk reward being long here is not that great, even though I am. I am net long, but way less long than I was here when I was buying. I pretty much sold most of this excess longs that I bought here. I was overweight long here. So it's just, I don't like being long when the risk reward is like 1 for 1. I prefer it to be at least 4 to 1. Okay, so here I don't want to get in right now when everybody else is getting in. Now, what I envision going forward, which is not what you should do, but technically speaking, you want to sort of forecast what happens, but also enter it when the situation is favorable. And for me, it's not. I'm hoping, quote unquote, hoping that it goes back down and retests the 200. It might not, okay? Because we are still kind of in fear, and we're not exactly at extreme greed yet. Maybe a couple more pushes higher might get us to the all-time highs, and before retesting, because there's going to be resistance at the highs, okay? But I think that we are going to probably correct a little bit. Maybe even cover the gap, but by no means are we going to revisit the lows. I don't think so. Like, this is just too strong. Like, you don't go super bearish, super bullish, then super bearish again. I mean, it'll happen, but maybe over time, but not in the next couple months or 3 months, not in the next quarter. I think, you never say never, but it just doesn't look that it's going to be this way, especially since the macro picture is still holding up. So let's reiterate, the technical picture is now full bullish, with a couple of asterisks that you look at, a lot of call buying here, so there might be a correction. But overall, we're back to being bulls, okay? So let's go to the macro, and we had some interesting macro prints. First of all, let's talk about the macro that happened based on like world events. And the reason we gapped up on Monday and continued to hold was that Trump and China agreed on some reciprocal tariffs to be reduced by 115% for 90 days. So he reversed this fear of tariffs, massive tariffs. So tariffs are lowered vis-a-vis China, which is the big tiger in the room. Okay. Plus, he has his tax bill, the Republican tax bill, might get passed next week or whatever. Okay. There's some hurdles with that, but the fact that trade deals are not as scary as we thought. I mean, trade tensions were not as high as it was before. Like, they're alleviated because China and the U.S. are sitting at the table and discussing. And the Trump bill and huge deficits are stimulative going forward, because we're still going to have a huge deficit under Trump. Make no mistake about it. Biden, Trump, when it comes to deficits, same animal. They're going to print a lot of money. So you have liquidity coming in there. And deficits are good, quote unquote, good for markets until they break them, until we have too much debt and the market says, oh, this is not good. But so far, that's not the case yet. Okay. So the macro speaking in terms of the trade deal was very, very good. Now let's go to the specific macro that we look at, which is inflation. The United States core inflation rate came out on Tuesday, and it was at 0.2%. They were expecting 0.3, so it came in colder than expected. Inflation falling, not increasing as people think it will under tariffs. Okay, so that destroy that narrative. Okay, tariffs might actually be deflationary, not inflationary, because of the slowdown in the economy. But whatever, we don't know yet. Okay, but for sure it's not inflationary, as inflation is still going down. Okay, and inflation expectations, like if we look at here, we can look at the break-evens. 5-year break-even rate down from highs since February, March, down. Sure, it rebounded, but it's on a downtrend. Okay, and still within between 2.25 and 2.65, you're not seeing it massively go higher. Okay, we'll get back to this later on in the podcast, in this session. But so far, inflation expectations are, as Paul would say, well anchored. Okay, and you can see that with the core inflation rate. Okay. What else did we have? We also had the PPI, the producer price. Remember, tariffs are supposed to make goods more expensive? Well, minus 0.5% on the PPI. They're expecting 0.2. 0.2, expecting it up here. Minus 0.5. Okay, so this, even core inflation is falling. Core PPI was minus 0.4%. They're expecting 0.3. So can we see that? PPI X food. This one. Minus 0.1%. So we had the PPI month over month and the CPI showing cold inflation. Okay. The next thing that came up on Friday was the initial jobless claims. Thursday. Initial jobless claims. 229,000. They're expecting 229,000. Nothing. 5 years, still in there. Let's go here. See, it's still within the range. This is not going to be a problem until it starts exploding upwards. We mentioned this 1,000 times. You know it. So the macro that we look at so far, very bullish, very favorable. Okay. The next thing that happened is building permits. This is what I wanted to show. Look, building permits, this went down, okay, to 1.4 million. They're expecting the previous 1.48. We got 1.41, and they were expecting 1.45 around here. So much less building permits. This we should watch, because if you can see, if it stays within this range, it's good. But if it starts dropping tremendously, and it's starting to drop, if it starts dropping a lot below the million, get to the 500K level, then we're going to have a problem. Then we're going to slow down. But that's not going to happen in months' time, so it's not there yet. Okay, we're going to find out in months, not in the next 1 or 2 months. Okay, so far we should note the building permit macro figure here. Okay, so this is what I wanted to get into. The next macro is the University of Michigan. Okay, which one is it? The University of Michigan inflation expectations. Okay, here's Zero Hedge is covering it well. Okay, and they're talking about the University of Michigan consumer sentiment 5-year expectations were at 5 point. I don't know why I didn't bring it up. Let's bring it. UMich inflation expectations trading economics. Look at this. 1 year inflation expectations for the University of Michigan was 7.3%, climbing 6. This is retarded, excuse me, but it's stupid. This is, and it's been shown, like if you see this courtesy of Zero Hedge, that the inflation expectations could be split between Democrats and Republicans. Democrats think it's going to be 9.6%, whereas Republicans think it's going to be 1.2%. The Republicans are still pretty low, but it's around, 2%, which is what the break-evens are saying, let's say. But even the 1 year consumer expectations are crazy. Okay. The Michigan 5-year expectations, let's see here, they're at 4.6. The break-even was what, 2.2? So there's like more than double the 5. They think the inflation for 5 years is going to be average 4.6% per year. This is crazy. Okay, this is just the problem with soft survey data. This is just manipulated by politics. Okay, so that's why even the consumer sentiment indicator, which came in at 50 here, like if you look at the University of Michigan consumer sentiment, which we do look at, it's at 50. That's extremely low. Okay, the 10 years, like even at the 2022 trough of that bear market that we had was at 50, and now we're at 50. Okay, it's just, again, politically motivated. So that's why I'm thinking of dropping this, or just like taking it with a grain of salt in the future, because if this soft survey is being politically influenced by politics and not like hard actual data, it's going to be completely useless. So that's why don't look at these soft data metrics, especially the UMich index. It's terrible. Okay, 4.4%, unbelievable. 7.3% in 1 year. In 2025, 7.3% inflation, 2025. It's stupid. Okay, so forget it. So let's conclude the macro with that it's really, really that stupid. Okay, I might even drop it from view in the future. Anyways, so that is the macro. As you can see, the inflation expectations, to recap, the inflation expectations were lower than expected. Building permits is the only one that we have to keep an eye on. But initial claims, good. Everything well within our bullish parameter. And we have SPY in bullish mode. So we have the macro that is still bullish and technicals that are still bullish. So back to being bulls. Okay. So let's talk about my favorite subject, gold. This is what happened gold Monday, Tuesday, Wednesday, Thursday, Friday. It fell. Okay. It went from 33.24 per ounce to close at 32. Okay, so it's down. I don't know. What would you say? It's down maybe 3% on the week, something like that. So it hit the key technically speaking. It hit the 50-day moving average. Still bullish, still higher low, okay? Yet it's holding, okay? I was expecting this to go even lower. I was expecting it to go around the 3,000. It could, because we're entering a very historically, seasonally weak period for gold, which is the second quarter. And the summer might have a little rally in the summertime, but it's usually weak in Q2 and Q3. It started getting strong at the end of Q3, okay? So I'm expecting gold to pretty much stay within these levels. And that would be bullish. If it doesn't, if it continues to go, maybe hit the 200, we would have room for pause, okay, and rethink our strategy or our outlook. But so far, it's still looking pretty strong when the market is up literally 23+% in a month and a half. Okay, so this drop from like 3,500 to 3,200 is like what, 10%? That's nothing. And it's still maintaining its bullishness, okay, because the underlying fundamentals for gold are still there. It's central banks buying, especially China. And don't fool yourself. Even if China is saying to Trump that we're going to sort of like talk, behind the scenes they're still buying gold because they want to like diversify away from the U.S. economy and the U.S. dollar. Okay, that's been proven. This is not speculation. This is why gold was going up since the beginning of 2024, before even Trump was in office. Okay, it doesn't do with tariffs. This is one of the most bullish charts I've ever seen. If it holds, we have to see. It might not. Okay, because this looks like a double top if you like that, but still holding its levels. Okay, so that's what I wanted to mention regarding this. Okay, the one thing that I think we should talk about that is giving me some pause is long-term rates. Okay, the U.S. 10-year specifically. The U.S. 10-year has been going up. Okay, I guess, I don't know why inflation, it's not for inflation because inflation expectations are going down. But overall it's staying at a high level at 4.43%. I get it, it's because like the economy is still doing well and inflation is falling. But the one little asterisk that I want to say is that if rates stay high, they have a lag effect. We can see the effect in like, it's been like this for a long time since 2020, let's say October 2023, okay? They've been at high levels, like 4.4, between always like around 3.8 to 4.8, okay? Always within this range. And this is not good for the economy, okay? If the economy, but we saw that the economy is still holding up, okay? But this will have a drag on it. So later on, I think maybe this might be the catalyst that is responsible for the next market hit, the next 10% correction. But so far, it doesn't seem to be affecting much. Okay, and if inflation goes down, okay, and this is the key, this is where one of two scenarios can happen. This is the only thing that the fly in the ointment. However, If inflation continues to drop, especially that we saw here, core inflation is at 0.2 and PPI is negative. So if things start to go negative, like a couple of negative inflation prints, especially here with the CPI, okay, which is the overall inflation rate, and core CPI going down, then you're going to have a situation where yields are going to go down. Okay, and when you have yields going down and the Fed expectations of cutting going up, then this market right here, rocket fuel. Okay, let's get rid of these moving averages. You get the picture? We're above the 200. You already know that already. This is rocket fuel. And remember, I was saying last week that if we get above the 575 and start holding above the 200 for like a week or 2 or 3 weeks and start consolidating, it's uber bullish. And the reason for that could be because inflation is going down and the Fed might actually start cutting. That happens, new highs, new bull market. Okay, make no mistake about it, that's going to be very, very good for the market and gold. You're going to see here a situation where previously gold would be going, would hold, like it ripped here when we had that panic. So this rip coincides with the SPY dropping, okay? But now we have SPY ripping and gold basically going down just 10%, okay? If we have rate cuts, gold is going to rip with SPY. It's going to be a situation where now gold is going to transform its stripes once again to being positively correlated with the market. You're going to have gold and the market, and it's going to be risk on, okay? And gold will serve as a risk on asset. It's weird to say. I know it sounds weird, but this is a case. This is why gold is so weird. It just switches, okay? And you're going to have gold ripping as well, okay, because of falling rates. And falling rates are good for the metal, okay? Plus China accumulating. It's going to be like a perfect storm for everything. This is going to be a situation where everybody wins, okay? So you have a case where, let's see, we haven't seen the Fed Watch tool in a while in terms of interest rates. So this is the Fed Watch tool, and this is for all of December. They're expecting 375, 2 cuts. So they're expecting 2 cuts. If this goes to 4 cuts because of falling inflation, with market near highs, rocket fuel, recipe for rocket fuel, if that happens, okay? So to recap, to reiterate, super bullish technicals right now. Okay, I'm expecting a slowdown because of like a lot of call buying. Doesn't have to happen, okay? Because we're still relatively, we're not at extreme greed, and sentiment is still quite bearish. This could change quickly though, but bullish, can go even higher. I'm expecting it to go down and then go high again. I don't expect maybe even the gap getting filled, then go high again, because we have positive macro and positive technicals. So I am bullish right now, okay? Although, like I said, I took some short-term protection just in case it goes down, because we're getting to the halcyon. Everybody's starting going long now. I mean, everybody starts buying here because everybody starts shorting here. That's why. It's like the inverse picture. So maybe a little drop down before going up. So that, with the potential, if going forward, that rates dropping would be even more rocket fuel. Oh, and a caveat. Don't forget that there could still be a situation where the highs might not get breached, but we stay flat up until September, October, like a sideways market. Keep that in mind too. Like if we come down and go up and it just stay here, it's very possible until another catalyst comes, okay? Although that would probably be my second case scenario, like a sideways market. The first thing would be bullish, pull back, and then come again. And then more than likely we are, in sideways markets or bullish to sideways markets for the next couple months in the summer, okay? So that's it for this week. Looking forward to next week. It's going to get exciting.